Imagine this. You walk into a bank. You make $40,000 a year. You got some credit card debt, maybe $800 in savings, nothing crazy. And somehow, the bank says, "Congratulations. You're approved for a $400,000 mortgage." No serious income verification. No deep dive into your financial stability. And you're sitting there thinking, wait, how is this even possible? But then you look around. Your neighbor just sold his house for a huge profit. Prices keep going up. The news keeps saying real estate is the safest investment you can make. So you sign. Because if you don't, you'll miss out. And that right there, that mindset, is exactly how the 2008 financial crisis began. My name is Dean, and I spend way too much time thinking about financial bubbles, debt cycles, and the psychology behind money. If you're someone who worries about rising housing prices, inflation, interest rates, or whether we're heading toward another crash, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because this isn't just a history lesson. This is about how money decisions spiral out of control when math and psychology collide. Here's the thing. Most people think the 2008 crash happened because bankers were greedy. That's part of it, sure. But that explanation is too simple. The real cause was something much more uncomfortable. It was a system built on one belief. Housing prices always go up. And that belief was backed by years of data that seemed to prove it. Between 1997 and 2006, home prices in the U.S. rose about 124%, according to the Case-Shiller Index published by S&P Dow Jones Indices. That's more than double in less than a decade. If a home was worth $150,000 in 1997, by 2006, it was roughly $336,000. Now here's what most people don't realize. During that same period, median household income didn't double. It rose only about 30%, according to the U.S. Census Bureau. So home prices went up 124%. Income went up 30%. That gap is not normal growth. That gap is a warning sign. But when you're inside a bubble, it doesn't feel like danger. It feels like opportunity. Let's break this down with simple math. Imagine in 2000 you made $50,000 per year. A conservative rule says you can afford a house that's about 3 times your income. So you buy a $150,000 home. That makes sense. Fast forward to 2006. Your income increases to $65,000. But now houses in your area cost $330,000. That's more than 5 times your income. So how are people buying these homes? They're not magically earning more money. The lending standards changed. Banks began issuing what were called subprime mortgages, loans given to borrowers with lower credit scores or unstable financial histories. In 2001, subprime loans made up around 8% of new mortgages. By 2006, they accounted for roughly 20%, according to the Federal Reserve. That's a massive shift in risk. And here's the crazy part. Banks weren't worried about whether borrowers could actually repay these loans. Why? Because they weren't keeping them. Traditionally, when a bank gave you a mortgage, it held that loan on its balance sheet. If you defaulted, the bank lost money. So they had an incentive to make sure you could pay. But in the early 2000s, banks began bundling thousands of mortgages together into financial products called mortgage-backed securities. They'd package 1,000 home loans, slice them into pieces, and sell them to investors, pension funds, hedge funds, insurance companies, even foreign governments. These bundles were often rated AAA, the highest safety rating, by agencies like Moody's and Standard & Poor's. AAA means extremely low risk. But many of these securities were filled with risky subprime loans. Investors bought them because they offered slightly higher returns than U.S. Treasury bonds. And in a low-interest rate environment, even a small yield boost looks attractive. Now you might be thinking, wait, didn't anyone see the risk? Some did, but most people were blinded by rising prices. As long as housing kept going up, even risky borrowers could refinance or sell before trouble hit. That belief kept the machine running. This is where adjustable rate mortgages come in. Many borrowers weren't getting fixed-rate loans. They were getting ARMs, loans with teaser rates. For the first 2 years, maybe you paid $1,200 per month. Totally manageable. But after that teaser period ended, your payment might jump to $2,200 per month. If you made $60,000 per year, that's about $5,000 per month before taxes. After taxes, maybe $3,800. A $2,200 mortgage now eats up over half your take-home pay. That's financial suffocation. But borrowers weren't worried because they believed they would refinance before the rate reset. And refinancing only works if your home value is rising. So everything depended on prices continuing upward, and then they stopped. In 2006, housing prices peaked. By 2008, they were falling sharply. From peak to trough, U.S. home prices fell about 27%, according to data from S&P Dow Jones indices. So imagine buying a $400,000 house. Suddenly, it's worth $292,000, but you still owe $380,000. On your mortgage, you're underwater. You can't refinance. Your payment resets. You default. Millions did. By 2010, nearly 3.8 million homes were in foreclosure, according to data from Realty Track. But here's what most people don't realize. The real disaster wasn't just homeowners losing houses. It was what happened inside the financial system. Remember those mortgage-backed securities? When homeowners stopped paying, those securities lost value rapidly. Banks holding billions of dollars of these assets suddenly faced enormous losses. In September 2008, investment bank Lehman Brothers filed for bankruptcy, the largest in U.S. history at the time. Panic spread. Credit markets froze. Businesses couldn't borrow money. Unemployment surged to 10% by 2009, according to the U.S. Bureau of Labor Statistics. This is where it gets really scary. When trust disappears in the financial system, everything slows down. Companies stop investing. Consumers stop spending. Banks stop lending. And the economy contracts fast. Now let's talk psychology. Because math alone doesn't create bubbles. Human behavior does. There was herd mentality, everyone buying because everyone else was buying. There was overconfidence, believing prices couldn't fall nationwide. There was moral hazard, banks taking risks because they knew they could sell the loans. And there was confirmation bias, people ignoring warning signs because the data supported what they wanted to believe. Here's what most people don't realize. Bubbles feel rational when you're inside them. It's only in hindsight that they look insane. In response to the collapse, the U.S. government passed a $700 billion bailout, known as TARP. The U.S. Department of the Treasury injected capital into major banks to prevent total system failure. The Federal Reserve cut interest rates to near zero and launched massive bond buying programs. Some people were furious. Why are we bailing out banks? They asked. But policymakers feared that letting the system collapse entirely could trigger a depression similar to the 1930s. Now, what does this mean for you? First, never assume prices only move in one direction. Housing, stocks, crypto, everything moves in cycles. If price growth massively outpaces income growth, that's a warning. Second, understand your loan math. If your mortgage is more than 30 to 35% of your take-home pay, you're financially vulnerable no matter what the bank says you qualify for. Third, be extremely cautious with adjustable rate debt. Teaser rates are seductive, but if your entire plan depends on refinancing later, you are gambling on future conditions you don't control. Fourth, build liquidity. A 6-month emergency fund is not optional. It's protection against volatility. And finally, think independently. When everyone says something is guaranteed, that's exactly when you should slow down and question the assumption. The deeper truth of 2008 is this. It wasn't caused by one villain. It was caused by leverage and blind optimism spreading across millions of decisions. And leverage still exists today. The assets change. The headlines change. But human psychology doesn't. The next crisis won't look exactly like 2008. It never does. But it will rhyme. And the people who survive financially aren't the ones who predict every crash perfectly. They're the ones who avoid excessive debt, keep cash reserves, and understand risk before chasing returns. Look, you don't need to live in fear, but you do need to respect the math. Financial literacy isn't optional anymore. It's survival. If this helped you understand what really caused a crash, and how to protect yourself in the next one. Make sure you hit that like button and subscribe. Because the more you understand money, the less likely it is to control you.